The Gwart Show is sponsored by Ellipsis Labs. Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. You may know of Ellipsis Labs by their first product, Phoenix, a fully on-chain order book DEX that's done over $50 billion in unincentivized volume. This is one of the strongest teams I know in crypto. If you're interested in working for a mission-driven company, Ellipsis Labs is hiring engineers who are passionate about crypto and finance to work on Atlas. You can learn more and apply on Ellipsis Labs Twitter, @ellipsis_labs. Don't forget to check out Atlas too, @AtlasXYZ on Twitter. Guys, today we have on the founder of Lombard Finance, Jacob Phillips, who's here to talk to us about Bitcoin staking derivatives, Bitcoin staking in general. I've never had an episode on this, and I am not super knowledgeable myself. So I hope this will be a good overview on the landscape here. Jacob, if you want to introduce yourself, and then, tell us what you're working on.
Definitely. Thanks a lot for having me. Appreciate it. Jacob Phillips, one of the co-founders of Lombard. Before starting Lombard, I was working on a DeFi perps protocol in Arbitrum called Perennial. We were part of a DeFi studio that was doing some other stuff. We were Comp Core devs working on an algorithmic stablecoin, doing some other stuff. And before that, I spent 3 years at Polychain. So I was a partner on the ventures team. I did some liquid fund research, and then I led governance there, for better or worse. And way before that, I grew up debating. That was kind of my thing. And then was doing traditional finance kind of in college, and very late in the game, started a CS major. Ended up going to work for a small startup accelerator in Cleveland that was launching a crypto fund. I wanted nothing to do with it. I accidentally got staffed on it, and the rest is history. Lombard is a Bitcoin liquid staking protocol built on Babylon. The broader vision is, Lombard is turning Bitcoin into a productive asset right now. If you want to do anything with your Bitcoin in a practical sense, you're either paying high transaction fees on chain, or you're going to a centralized exchange or trusting some other intermediary. Bitcoin is the best decentralized money. You should be able to use it in trust minimized contexts. So, we're starting with Bitcoin liquid staking as both the catalyst and the bridge to onboarding Bitcoin into DeFi. And I think a lot more will come from that.
Yeah. So, okay, can you just give us an overview of Bitcoin staking? I know you guys have a relationship with Babylon, and then we can kind of get into the actual, liquid derivative part. But how does Bitcoin staking work, at least in its current form?
Yep, great question. So the simplest way to think about it is it's like eigenlayer for Bitcoin. So there's this protocol called Babylon, based on the stake chain paper, I believe, by Robin Linus, same guy who sort of built the foundation for BitVM. And basically what this allows you to do is, so Babylon originally was setting out to build this timestamping protocol, basically to allow non-Bitcoin chains, call it Cosmos chains, any sort of blockchain to create a timestamp of whatever the latest finalized block was to the Bitcoin main chain. And then what people ultimately figured out was timestamping protocol, cool, but even better if you could include a slashing mechanism in there, actually stake a Bitcoin. So Babylon allows you to time lock a Bitcoin, sign block updates, basically finalize all non-Bitcoin blockchains. And in the process provide economic security. So in the same way, when you're staking ETH and delegating to an AVS and eigenlayer, you're providing economic security for those AVSs. You're doing the same in the Babylon ecosystem. So any sort of Cosmos chain or OP Stack rollup, and I think they're expanding the set. You can sort of stake your Bitcoin and provide economic security to those chains. So really cool mechanism. I think. In particular, they built it in a way that's directly using Bitcoin script. You can do it fully non-custodially from your self-custody wallet. Sort of the first time somebody built a pretty expressive, maybe not the first, but most notable example, I think, in modern times of an expressive protocol built directly upon Babylon or rather Bitcoin, as opposed to just bridging assets into a new ecosystem.
Okay, and so then LBTC, which is Lombard's staking derivative, is a staking derivative used on Babylon stake chains. Is that correct?
Exactly. Yeah. So users deposit Bitcoin into the Lombard protocol. Lombard, you can kind of think of this as like a security layer on top of Bitcoin. We then stake that Bitcoin into the Babylon protocol, cover all the hard stuff, delegating to AVSs, security stuff, picking the right validators. And then we mint LBTC, which is a liquid representation of that staked Bitcoin, on any of a number of chains. So majority of it's minted on ETH mainnet right now. We just sort of upgraded to allow for native minting to Base and BNB, and soon we'll go to Solana and Sui, and pick your favorite chain and we'll be there.
Okay, so when you say now it's minted on Ethereum, that is through Babylon's stake chain version of Ethereum on the other side. Is that correct?
Not quite. No. So think of Lombard protocol as the middle layer. So you can kind of think of Lombard as two things. It's a liquidity primitive and a security primitive. So the liquidity primitive is LBTC. We mint this token. It's backed by some action, in this case, staking that Bitcoin into Babylon. You can take this, ERC20 and use it wherever you want to.
Okay.
But then the security primitive itself is like the underlying Bitcoin is secured within the Lombard protocol. So Lombard, initially takes a consortium approach. So it's sort of an honest majority assumption of a permissioned validator set. In my opinion, this is like the only way right now to secure 10 or $100 billion in Bitcoin securely. And over time, I think that security primitive will evolve. What's maybe kind of interesting about that is that Lombard is really the only one in the Bitcoin LST space even attempting to build the second piece of that, which is the security primitive. It seems obvious when I break it down as like liquidity primitive and security primitive, but most people have sort of punted on the question of how do you actually build, secure Bitcoin, in a sense of like every other LST is this. It's like this messy map of different centralized exchange or centralized custody accounts that they store the Bitcoin in. So when you deposit into any other protocol, you're like depositing into maybe the Kobo account, maybe the Cefu account, maybe something else. I don't know. It's sort of like hand wavy based on what the team decides. Lombard's kind of been the first to step up and be like, if we're going to build these LSTs, we should build them as a protocol, something that is built to be a hyperstructure with some sort of centralized foundation. So sort of interesting evolution. I think everybody's going to end up moving that way because we set the standard. But it has been sort of fun to see the space evolve. Fun's maybe not the right word. It has been interesting to see the space evolve in such a context where people make their own decisions about what users should or should not care about with regard to security and decentralization.
Yeah. Okay, that makes sense. So what is your view on like the current landscape of native staked Bitcoin through Babylon? And then obviously you can talk about your liquid staking derivative or liquid staking token. Where is the demand side coming from chains there? And like, what does that look like right now?
Yeah. Another good question. So maybe before I talk about the demand side from the chains, I can at least say that the demand side on the supply side of Bitcoin holders has been immense.
Yeah.
Staking is something Bitcoin holders are relatively familiar with on a broad basis, or at least have some idea. It's a pretty comfortable risk exposure for them to take. The fact that Babylon allows you to stake directly from your self-custody wallet, I think is pretty impressive. There are some trust assumptions built into Babylon, but they're like highly minimized. The sort of the worst that could happen is Babylon sort of like withholds a withdrawal, but then eventually your Bitcoin times out anyway. So it really is like a true minimization of trust as far as a staking protocol goes. It's not like you're surrendering your custody to some other party, which has resonated with a lot of big Bitcoin holders who really don't trust anyone, and they only want to do things that are non-custodial. So demand has been immense. I mean, we saw like I think Babylon has like $6 or $7 billion in TVL right now. It's only staking has only been live for like a week and a couple days. So it's clear that people want to do stuff with their Bitcoin. As all of the centralized opportunities to put your Bitcoin to work dried up, now on-chain opportunities have taken a front seat. Fundamentally, what's happening is that Bitcoin is being staked into Babylon is ultimately going to be delegated to AVSs. In this case, they call them BSNs, Bitcoin Secure Networks. This isn't live yet. Babylon still needs to ship the finality gadget, which is sort of the last piece of this that actually allows for validators to sign final block updates to the Babylon chain that then can sort of be slashed if they equivocate. The idea here is that demand is primarily going to come from it's kind of interesting. They're starting with existing chains. So like existing chains in the Cosmos ecosystem. Babylon's protocol is partially built on IBC, which lends itself well. And then they have these sort of adapters to fit with other kinds of protocols, particularly ETH rollups are obviously a target for them. I guess I think they have some early partners on board. It'll be interesting to see how much this scales. I think like Babylon and EigenLayer are sort of competing in the same space. People looking to go to the market to get third-party security are looking at a number of these platforms simultaneously. What Bitcoin has going for it is that there are so little other risk minimized forms of Bitcoin yield in the ecosystem that Bitcoin is probably, well, almost certainly the lowest cost of capital asset on the planet. And so if you can leverage that as security, it ends up being sort of a way that, Babylon is somewhat undercutting some of these other platforms, which, we'll see how that plays out. The only major difference worth calling out between Babylon and other platforms is that while I think Babylon will eventually become fully programmable staking, or rather like a fully programmable security market, right now it only protects against double signing. So that's sort of the one. It's like, it prevents long range attacks. It doesn't really do all that much else. Not, you can't slash for downtime. You can't slash for like things like insurance or other use cases, but I'm sure the use cases will be built up to that.
Yeah. Okay. So you mentioned there's like a tremendous amount of demand. I've seen this, I think when Babylon first opened up, like there's massive Bitcoin fees, right? We saw this like in the mempools, like because everyone's trying to stake. But so my first question is like, you mentioned there's like a lot of latent demand for Bitcoin. I think that's a reasonable assumption. I mean, clearly. So who are these, like, who are these people that are depositing right now? So yeah, maybe one, who are these people, like massive whales of Bitcoin holders? But the other question I have is, you said there's no like finality gadget. So there's not really like chains using this in its fully functional mode. What is the kind of like yield they're receiving right now?
So I think the types of people who are depositing into Babylon right now are a big mix of people. You sort of have the lowest hanging fruit, which are EigenLayer and ETH stakers who also happen to have a massive bag of Bitcoin, who now with the opportunity to put it to work are doing so. So I think that was sort of the lowest hanging fruit. But Babylon's done a tremendous job, because of the way the protocol was set up to be non-custodial from the start, of onboarding a big range of people. Like you're getting a lot of OG miners who are finally deciding to put their Bitcoin to work. You've got institutions looking at this. You've got some of the biggest Bitcoin holders in the space, at least testing this out in some context. So I think I would describe it as mostly kind of more crypto native users who are going in size. And then you have, some of the bigger players like starting to dip their toes in. One sort of telling tale sign here is like, on the Babylon testnet, you had the three largest mining pools all running Validator or finality providers rather. So, I mean, the Bitcoin community is paying attention to this in a big way. And I can only imagine that as it becomes more robust, you got to remember, like, Babylon is a couple months old at this point. Like I said, it's, there's been these 3 staking windows, which in aggregate have only been like a week and some change. So while I think, $6 billion in a protocol for a little while is decently battle tested, it's got a long way to go, especially if you're like a big insto or somebody with a lot of money. And the second piece was, where does the yield come from? So right now, no native yield. Think of this as the stage before EigenLayer, yield starts getting paid out, where the only sort of yield is in the form of Babylon points, potentially, assuming there's some conversion there. But I will say, I think that, this is a really exciting stage for Lombard, because I think, the reason I originally got really excited about Babylon was, of course, I think security markets are interesting. What was even more interesting for me as like, someone who's heads deep in DeFi nonstop, thinking about like how we take DeFi to the next level, was the opportunity to use this as catalyst to onboard a ton of net new liquidity to DeFi. And Babylon has even taken this approach now as well, where they're sort of selling a dual product of security and liquidity to new chains, which is pretty cool. EigenLayer kind of did this with liquid staking tokens and yield-bearing collateral in the ETH ecosystem. Nobody really built with yield-bearing tokens. And then all of a sudden, EigenLayer created this massive exogenous catalyst for people to start using those tokens in DeFi protocols. And every single DeFi protocol then, made like liquid staking tokens, restaking tokens, and yield-bearing collateral like a core part of their part of their growth strategy. And I think, Babylon has been a massive catalyst for doing the same in the Bitcoin ecosystem.
Yeah, that makes sense. Okay, so like clarify this for me. Is there such thing as Bitcoin restaking currently, or is it just staking, right? Like intuitively, I understand why on Ethereum it's restaked, right? Because it's already been staked and then it's been restaked to provide security for, other chains. On Bitcoin, right? There's no proof of stake mechanism. So this is just native. I mean, to the extent that it's trust minimized, native staking, right? Is there restaking already or no? Because I've heard this term, but I don't know what it means. Okay, so what is restaking then? Would they use a token like Lombard? Is that the idea?
Yeah. Well, so I feel like restaking has become a meme at this point. Anytime anybody can restake anything, they will find a way to do it. In this case, there is a restaking product out there called EBTC, built by the EtherFi team, built exclusively on LBTC. And the idea is, if you think of staking Bitcoin into Babylon as base layer staking, then restaking LBTC into Symbiotic, Eigenlayer, Karak then becomes restaking. So that's sort of the concept. But there is some nuance here, because unlike ETH staking that is very sort of uniform and vanilla, there is even staking to Babylon is a bit of a dynamic endeavor, right? So it's almost like restaking squared in some ways.
Okay, but explain to me why somebody would use restaked Bitcoin to secure their chain versus just using Babylon itself.
Yeah, I think it just goes back to different technical capabilities right now. Babylon and Eigenlayer, I guess, in some ways are like directly competing on the issue of providing economic security for equivocation. But outside of that, there are things that you can build with Eigenlayer that you can't build with Babylon. So I think that would be the idea. So maybe a good example of this is, Lombard has, the security primitive Lombard Ledger right now, sort of a permissioned validator set, but is expanding to basically a common BFT chain built on the Cosmos SDK, expanding to 21 plus validators, something like that. This will be secured by Babylon security for equivocation, double signing, but then we will also leverage, Eigenlayer Symbiotic, a restaking platform, to do other things. So in this case, like, we're mostly interested in providing some sort of insurance mechanism where LBTC stakers can restake their Bitcoin to provide insurance should there be some sort of shortfall in the system, from a slash, from a hack, from whatever it may be.
Yeah, maybe it's like a slightly different use case, but Lombard is like a layer on top that is then allowing chains to connect for various other reasons. Whereas they may decide that going like directly through the Babylon route is that doesn't make sense for them for whatever reason. Okay. Okay. Can you talk to me? Like, I don't know exactly the question I'm asking here, so you're gonna have to run with this. What do you think is like the long-term kind of economics of, we'll just stick with like because I've observed Eigenlayer thus far, and I really don't have a lot in the way of conclusions to draw, because I'm very skeptical maybe right now of whether or not it really makes a whole lot of sense for these chains to pay for the security in this way versus, I don't know, launching their own rollup or whatever, right? Like the kind of AVS model. So like, talk to me about Bitcoin staked chains. Like, what does it look like long-term in terms of like your thoughts on yield? Like, as you said, you could probably offer much lower yield for Bitcoin chains, but I'm just curious, like, how you see this playing out.
It's a good question. Long term, I'm not totally sure. In the short term, I know that these chains will end up competing in the same security marketplace that Eigenlayer, Symbiotic, Karak are competing in. On a broad basis, the whole idea of, when I was at Polychain, I spent a ton of time digging into the Cosmos ecosystem. Cosmos is always sweet if you're like, Polychain Labs, Figment, P2P, whoever, you get like 20% yield on your crypto every year for doing nothing. I think those days are gone, right? Like, we know that there's observable demand for paying for security. I mean, I think it's like a multi-billion-dollar market already as it exists, and all of this should come down. I mean, the fact that you can use third-party latent liquidity to secure your chain is like fundamentally better than using endogenous collateral. Not everyone agrees with this, but at the end of the day, you're paying for some slashable outcome if you can get it from an external party for much cheaper. I mean, I think this is probably going to end up being like 5 or 10% of what people used to be paying, minting, rather inflating their native token to pay for this. So Babylon is sort of competing in that marketplace. I think the thesis is that, over the next 5-10 years, as everybody's launching, as everybody and their mom is launching a new chain, that people will opt for economic security in a third-party context by going to one of these marketplaces like Babylon or Eigenlayer. I think the big question is just like, how much does this scale? How much demand is there for economic security? And, we go back and forth on this a little bit, right? economic security is a meme or isn't a meme, depending on who you talk to. But at the end of the day, I think as we become more institutional as an ecosystem, I can imagine that at least some security, economic security, is going to be demanded by each and every chain that launches, just to sort of like set the foundation that the rules are the rules and you can't break them. Without economic security, I feel like you're going to run into too many of these edge cases where it's like, technically it would be better for the ecosystem if I did this rather than this, you know? Like imagine if Bitcoin didn't have the principle of no rollbacks, and you ended up in that situation back in like whatever it was, 2019 or 2020 or something like that, where Binance gets hacked and they're like in a room with some of the mining pools trying to decide if they should roll it back. With economic security, that's not a decision, right? It's like too messy to ask people to go get slashed and then get paid off chain. I think it just creates too much. It's like there's a lot of security mechanisms built into chains, not just economic, but I think the economic piece at least creates it creates like a little bit of a safety mechanisms for validators to obey the rules of the protocol rather than having to think about all these convoluted external incentives that would drive them. I think that the simple sort of, it sort of lets them put their hands up and be like, hey, I'm going to get slashed if I do this. I can't trust anything else outside of this. I don't know how that plays out in practice precisely because I don't know that we've really seen this. I mean, we know that economic security has prevented some forms of rollbacks from time to time, but I feel like we haven't really seen the opposite, you know, because right now, economic security is sort of a bit of a default. It seems like if you're launching a new chain, you kind of by default launch with economic security. But maybe we need to see some of the opposite to get the full picture.
Thanks for listening to The Gwart Show on the Blockspace Podcast Network. Subscribe to our newsletter at blockspace.media to get the show directly to your inbox. Show links, transcripts, and Bitcoin articles twice per week. Stay ahead of the conversation by visiting blockspace.media.
Yeah, I'm curious now. Eigenlayer's a little bit more mature. I mean, at least to the extent that it's existed longer than some of these Bitcoin staking derivatives and Bitcoin, like staking, restaking protocols. Is there anything you've learned or observed from Eigenlayer in the way that they launched, or maybe one of these other, Carrick, is that what it's called? And I know Symbiotic. Is there anything you've observed that has sort of been like a lesson going forward for, or maybe how it would differ in the Bitcoin ecosystem in terms of staking and restaking?
Yeah, it's a good question. I mean, there's a lot of stuff. One was, Eigenlayer chose to build on ETH as the predominant asset, sort of making this as the prime collateral within the ecosystem. If you're going to build economic security in Eigenlayer's vision is this programmable trust primitive that, everybody can use, to build that on top of ETH as money instead of, other assets, I think is a little bit of it's, I think, a big wake up call for the whole Bitcoin ecosystem to recognize that, in some ways it is losing this battle if it doesn't sort of step up as the core collateral in the ecosystem. I think that was an interesting thing. Eigenlayer flooded the supply side massively when they first started. This has kind of been the same mechanism that Babylon has used. What it did do was it sort of created enough, probably like enough and cheap enough security to help bootstrap the first stage of the marketplace. But I think what's very clear is that wasn't a sustainable strategy. There probably was like a sufficient extent to which you flood the supply side of the marketplace before you could, kind of turn off the nozzle and start focusing on building some sort of semi-gated yield ecosystem. Because I think that's the biggest risk here to these systems, right? Is like when AVS yield gets turned on, restaked assets or staked assets in the form of Bitcoin at Babylon earn like 0.01% yield, and you're not even being compensated for the risk you're taking on. At that point, I think there'll be some issues. But by and large, I think the other thing that I think we sort of learned was everybody was sort of maybe thinking about these things in the wrong context. The early, the first versions of AVSs were everybody was launching an AVS on Eigenlayer, at least for the first many months after it launched. It seemed like everybody was just doing it to bootstrap something else, it was like a good go-to-market to be an Eigenlayer AVS. And, I'm sure there's some of this in the Babylon ecosystem too. And, in some ways they're even trying to productize it by making like liquidity sort of a shared offering along with the security. But I think people are going to come up with much more interesting mechanisms that are actually fundamental. Restaking at its core is sort of just rehypothecation of collateral, which is one of the most powerful primitives that's native to DeFi. I think there's a lot of really interesting ways you can use this outside of just economic security.
Yeah, that's what I was thinking. And I mean, you can maybe talk a little bit about like what do you call it? The ledger, the Lombard ledger.
Yeah, Lombard ledger.
Yeah. So like, what do you envision in this capacity? Because like I had sort of the same reaction with these AVSs, right? And like maybe there's something more novel and like you talked about this potential like insurance, right? Idea.
Yeah.
Maybe more like app chain specific versus like full blown, just, generic roll up that is instead using kind of like this shared security. Like what do you envision like as something that could be, I don't know, innovative or like a step function, in terms of, like creating a new primitive?
Yeah, insurance is the one that really, really comes to mind as the biggest thing that we've started to see people develop. Insurance has been this idea in crypto that everybody has been trying to build for years and years and years. When I was at Polychain DeFi Summer, I think we saw like 8 or 10 different approaches. Nexus Mutual. I was actually just watching DeFi Llama had this like this retrospective of DeFi. Nexus Mutual at one point in crypto, DeFi native insurance protocol was like a top 6 protocol, which is pretty crazy in retrospect. But and all of like the whole business of insurance is built on rehypothecation of collateral, basically like trying to earn a little bit more than what you pay out. And so this is sort of been the base of restaking to begin with, is sort of this like roughly insurance for economic security, but it becomes even more powerful when you can do it for other use cases. Like maybe the most significant thing that Eigenlayer did fundamentally was they like got a shit ton of assets in the protocol that they could then rehypothecate, like they could put towards different use cases. And most of the way that people have kind of been thinking of insurance right now in the Eigenlayer ecosystem, I think has been sort of based around tranched risk. So in the case of like LBTC, which I was just describing, you can kind of like restake your LBTC within a restaking platform to sort of get like a higher yield junior tranche effectively, where you take on the slashing risk of, while regular LBTC has a little bit of reduced slashing risk. This is sort of a cool mechanism. I think it'll be even cooler when we start thinking about this beyond just chains and economic security. Like I wonder if DeFi protocols will start. Well, I think we've seen this a little bit. Like DeFi protocols will start. Have thought about starting to use this for like short-term liquidity demands, like fast withdrawals for L2s or like fast withdrawals for Lombard, so you don't have to wait the 7-day Babylon unbonding period. These are kind of cool things. I think the problem with a lot of this is, again, it all comes back to scalability and to like need. The question of whether people are going to pay for economic security kind of goes back to like how pressing is the issue of economic security. And I think the same question will be asked for all of these kind of rehypothecated solutions. Like, is insurance needed for this use case? In the case of like fast withdrawals, I think it's like night and day, 100%, valuable solution that people are willing to pay for. And so I'm sure there will be more use cases that will pop up. Like it'd be cool to see a DeFi protocol build upon Eigenlayer and basically leverage all of that liquidity for like a short-term liquidity crunch somehow.
Yeah, I mean, it seems like, look, I'm just going like off my own intuition here. It seems that maybe Babylon is already realizing that they're kind of selling this liquidity aspect too, on the grounds that, yields are probably going to compress, right? Right now, we have this kind of like speculative phase where more than likely there's kind of a points farming dynamic, and we don't know what like native yield on Bitcoin looks like long run. And as you said, like extremely low cost of capital, it's going to be maybe more difficult to incentivize, Bitcoiners just on the grounds that, it's a very like scarcest asset, right? Like to kind of put Bitcoin at risk. So it seems like maybe that going forward, I mean, is that like your take on why they're also going maybe this kind of like different route from like a business perspective?
Yeah, I think it's a fair point for sure. I mean, we definitely feel this way. It's like you think about if you're a chain or a DeFi protocol or whatever, your most pressing need is, am I going to survive or not? And liquidity is what defines that, not security. Yeah. Security sort of only matters if liquidity is bootstrapped. So that's sort of the thesis I think Babylon's taking here is like, if liquidity is bootstrapped on all these chains, then you need security. You might not need it out the gate. So when you look at like what's being built in the Eigenlayer ecosystem, I think I actually don't know if there are any existing chains that have turned to Eigenlayer security. Probably some like upgrades from to new systems or something like that. But by and large, it's brand new protocols launching with Eigenlayer security. Babylon's kind of done this cool thing where they're taking existing chains and like creating this sort of layer of security on top, which is kind of neat. But yeah, I think you're absolutely right. I think this is true with all of DeFi. Like all of DeFi is slowly learning that you've got to solve real problems, otherwise you're kind of screwed. I spent a lot of time investing in protocols at Polychain and even building a perps protocol that just wasn't solving a pertinent enough problem for users. And going back to the basics of like, what do people care about? What moves the needle for a project? I think is like a must for anybody building this space.
Yeah, that makes a lot of sense. Okay. So what is the business model for Lombard? I assume that generally speaking, you're talking about this Hyperledger shared security restaking. That seems like there's margins there, but is there margin? I mean, is there a business model in, I'm being reductive here, but like a wrapped version of Bitcoin, less so, right? Like we've seen this with Bitcoin. It's like it's not like extremely lucrative business. It's more like like almost like an onboarding cost or whatever, right? So like what is your perspective, like the long run of Lombard, and like how does it sustain itself from a business perspective? In
general, I think of what Lombard's building, both on the liquidity and security primitive side, as public goods or minimally extractive protocols for the ecosystem. You're totally right. Like WBTC ultimately had to make some business decisions and in turn pissed off their entire community. There wasn't a great business model there. With Bitcoin liquid staking, there is a pretty clear business model. Like we could use the same sort of business model as Lido. Lombard assets are staked. They take in some yield. You can take a cut of that. Lombard is also sort of a bridge, so you can imagine there being like mint redeem fees for LBTC, which there are none right now, or there could be some like bridging fees for moving from one chain to another. Native minting on a new chain. There's all these things that could happen, but it's not a concern for us even in the slightest right now. Like the goal is to just grow this rock solid primitive and then figure out what comes next. And I think I wouldn't be surprised if like LBTC and if we launched like a Bitcoin wrapper or something like that, that those could just be public goods that we take as little economics as possible as a protocol, just to sort of grow the ecosystem and maintain I guess pay the security budget effectively for operating that asset. And then everything else could be tuned into some other business that's sort of periphery to all of this. But yeah, we'll see. I really like, what is it? I think it was either Chris Berniski or maybe it was Joel. One of the placeholder guys had had this piece on like minimally extractive protocols way back in the day. And I don't think enough.
I think I've read that.
Yeah, it's a great one. I don't think enough DeFi protocols think like this. It's like the protocol isn't meant to be a business. And I think when people think of it a little bit too commercially, that's when you run into problems. Bitcoin LSTs right now are predominantly thinking of themselves as business, like yield vaults. Yield vaults are going to be like hyper competitive with everything else in the ecosystem. The goal here is to create a monopoly on an asset that has like some, that basically molds itself into a hyperstructure, something that can last years and years and years.
It's like the volume based.
Exactly.
Yeah.
The one widely adopted, super liquid, highly robust Bitcoin primitive that people use to take Bitcoin cross chain is going to be worth way more longer term than like a good yield product in the next 5 to 10 years.
Yeah, I wanted to go back for a second. I had one other question regarding the kind of Babylon model and then integrating chains. Is it pretty easy for a chain? Like, so can you say that maybe have some relationship with the Optimism stack right now, or they're going to? I mean, is it as simple as just copy pasting a roll up and the new security model is Babylon versus an L2, or I guess maybe in this context would be closer to an AVS, but is it really is it that simple, like in terms of integration, or is like a more of an undertaking? Yeah,
depends what kind of chain you are. So if you're a Cosmos SDK chain or something IBC compatible, it actually doesn't have to be Cosmos SDK. It's really easy to add on top because all of the message passing sort of happens through IBC for Validator. So like when you're running a Validator node, you're signing finality updates that go to the Babylon chain over an IBC channel. But then ultimately gets either allows for the slashing mechanism to occur. So this is super easy. So like part of the motivation for Lombard building a Cosmos SDK chain initially was to become secured by Babylon. However, they're building adapters to other things. So like if you're Solana and you want to take advantage of Babylon security, would be really hard. It would require consensus changes. Doesn't for Cosmos ecosystem chains. and the building adapters basically to do the same thing for that Babylon has done for IBC chains for OP stack rollups. I think they're doing the same for Arbitrum rollups as well. I think Orbit. I think that's kind of the direction they're going. Is they're basically trying to take like all of these standards that people are using to launch new rollups, chains, whatever. They're sort of making integrations for that.
Yeah. What do you think? Just like this is a little bit outside of the scope of Lombard, but like, what is your perspective on a chain deciding to use staked Bitcoin versus just, an OP stack chain or I guess it's called Arbitrum Orbit or Style. I forget what it's called, but anyways, one of those chains. Why would they choose? I think the obvious answer is that like maybe people prefer Bitcoin and Bitcoin collateral is more liquid and has a higher market cap, whatever. But like in terms of integration, like where do you see who are the most likely chains to want to move to like a Babylon staked model?
The most likely chains are definitely chains within the Bitcoin ecosystem. If you're already Bitcoin aligned as a product, it's sort of a no-brainer to then be secured by Bitcoin. Like Lombard building a Bitcoin bridge, it would be silly to have a Bitcoin bridge backed by ETH or some other asset. Yeah. At least in theory, from an alignment perspective, or trust assumptions perspective. However, I think ultimately, like people are a little bit too philosophical about what asset it should be. Even the way I presented that right there, like, a Bitcoin bridge should be secured by Bitcoin. It doesn't make a difference. Like the slashing mechanisms are designed to be generalized enough to work with any asset, provided you provide the right, the right parameters to allow for it. So my guess is that ultimately users will just choose whatever the cheapest security is. Bitcoin and ETH should be perfect comparables as from a security perspective. Bitcoin maybe even a more liquid collateral. So assuming that the two are on par in terms of other aspects, it would be sort of a no brainer to adopt Bitcoin over that. And it's really like Bitcoin, ETH, stable coins will probably be decent collateral for these security marketplaces. And then outside of that, it's just native tokens from projects, which goes back to endogenous collateral within staking systems, and we're back to square one. So I don't really think there'll be a whole hell of a lot else that'll sort of make sense there.
Yeah, it seems like again, just my own intuition is that it seems like if staking both on the Ethereum and Bitcoin side really take off, and this is sort of the preferred model, that we see fewer, tokens and certainly fewer probably gas tokens. And it just seems like, there's going to be less and less demand for using like this sort of, flywheel or Ponzi system, right? To bootstrap or create these chains. Who is your competition in the LST space?
Yeah. So there's a number of players, Solve protocol, just about to TGE, interestingly, Pump BTC, Bedrock.
Pump BTC?
There's another Pump. Yeah. PUMP BTC.
Did that come off Pump.fund bonding curve or no?
No, it didn't. No, this is, I don't know. I mean, it's a little bit of it's, the design they take is a little bit of like a playful retail focused approach, but yeah, the pump team's good. I mean, all these guys I think are good teams. Have had a pleasure working with them or competing with them in some respect. But yeah, like I said, everyone's taken a little bit of different design decisions, and I think the one big thing that has differentiated Lombard was we were sort of like ETH DeFi guys coming into the Bitcoin space, trying to onboard Bitcoin into the ETH ecosystem. So, I mean, these primitives were live for 4 or 5 months before us, some of them, and had zero DeFi adoption. Like the first thing Lombard did, we weren't going to launch LBTC without this being a deep liquidity asset in DeFi. That's kind of been the priority from the beginning. And that was sort of the original motivation, was like, could we bring all this net new liquidity to existing DeFi ecosystems? And then of course the other thing I mentioned earlier was we've just taken a very different security approach. But yeah, it's been fun. Lombard, of course, is sort of like best of the best. I think we're like 1.7 billion in TVL, almost twice number 2. We're like $100+ million in on-chain liquidity. This is like 5x the number 2. And yeah, just about to get listed on Aave, on Fluid, on Moonwell. Sort of like the choice of collateral within the DeFi ecosystem.
Yeah. Okay. That makes sense. Are all those other Bitcoin LSTs you talked about, are all those under the kind of like Babylon ecosystem?
Yes, yeah, all under the Babylon ecosystem. I should clarify though, there are actually Bitcoin LSTs. Like there was Swell BTC for a little while, and there might be others that are actually like Bitcoin LSTs, but in the ETH ecosystem, where you take in WBTC or CBBTC and stake it on EigenLayer or someone else. But none of those. I mean, this is the reason that like I only mentioned the Bitcoin.
Yeah, that's what I was going to ask you about
LSTs.
next.
Yeah, it's a good question. There hasn't like staking Bitcoin into EigenLayer or Symbiotic or some ETH restaking platform hasn't moved the needle even a little bit for those platforms. Like in the same way I was discussing earlier, like if you were an LST and you wanted to grow, you sort of bootstrapped off of EigenLayer in order to bootstrap a lot of usage. Like EigenLayer was sort of the catalyst for getting people excited about that. EigenLayer and these restaking platforms have been predominantly focused on ETH as an asset. And on it, we've had a lot of conversations with these guys. These guys don't actually really think that Bitcoin is as an asset has product market fit within these systems, which sort of perplexes me given the generalized nature of what they're building. But they would sort of prefer to focus on ETH. So Babylon was the first to sort of come here and be like, okay, Bitcoin is the priority. We're going to be all about Bitcoin here. So, because of the sort of exogenous incentives built within Babylon, Babylon LSTs have just grown much, much more significantly than anything you've seen in the ETH ecosystem. And really, this has been like the first true catalyst for Bitcoin and DeFi as a whole. Even if you look at like WBTC and CBBTC, like Lombard is on par. I think we actually have more TVL than CBBTC right now, which is like pretty crazy to say, but that's the power of the catalyst here. I think this is the one thing that's been missing. Like everybody's known. I mean, in 2020, I was researching Bitcoin DeFi for Polychain and we were investing in projects. But Bitcoin never got to critical mass. ETH is a pretty damn good collateral also. And, in close proximity to all this liquidity on ETH mainnet and these L2s. So why would you use Bitcoin, a lower liquidity asset with, all these additional trust assumptions built on by these wrappers? It sort of didn't make sense. You needed some sort of catalyst to make this all happen. And that's what Babylon's really been that for the Bitcoin DeFi space, a bit of a savior in that sense.
Yeah. So is that kind of how you see yourselves differentiating from WrapBTC and CBBTC? I mean, in the long run, right? Like what is the selling point for users to hold and use LBTC? Is it, primarily the security model? Is this kind of like how you would distinguish versus these other wrappers that, WrapBTC does have, sort of a large market share right now.
Yeah.
Obviously it has some changes as of late that you mentioned kind of pissed off holders, but is this sort of like the selling point in your mind in terms of like competing against these well-known established wrappers?
Yeah, in the short term, the liquidity model of Lombard is a huge competitive advantage. The fact that we have Babylon as the catalyst, built in, a yield-bearing collateral, the fact that there's all these sort of like economic incentives flowing around this asset, this has been huge. The fact that we are a team that can go integrate this within all the biggest DeFi protocols. At the end of the day, it's like people want to hold Bitcoin LSTs as much, maybe more than they want to hold wrappers right now, because wrappers just don't do all that much. But I will say, I don't think that's a long-term catalyst. At some point that's got to happen. So what I would say is like, WBTC tried but failed to reach critical mass in DeFi, depending on how you define that, right? Like WBTC didn't replace ETH as the core collateral within DeFi. Didn't even really give it competition. And everybody I talk to is like, yeah, Bitcoin DeFi is kind of dead because they're looking at WBTC sitting within Aave at like, 10 bips of yield or something like that, earning nothing. There's sort of this renaissance happening driven by Babylon. So Babylon is sort of reallocating liquidity within the Bitcoin DeFi ecosystem to these LSTs. And then the fundamental difference for Lombard long-term has to be that we become like a true non-custodial form of using this. Like, while Babel or, WBTC and CBBTC are good assets, I sort of don't think that they're just going to like win independently. Like, again, you sort of need to get to this point where there's like critical mass of the asset to the point where it actually can compete with other assets, ETH and USDC and stables as collateral. And it's sort of not there yet. I think Bitcoin LSTs are probably our best chance to make this happen. Though it's worth noting, like all these assets are symbiotic within the ecosystem. Like Lombard, I think we're like the second largest WBTC pool on Uniswap V3, and I think we're we're also the second largest CBBTC pool. So we're like growing a lot of liquidity of these wrappers in tandem. But long term, I think what happens is like Lombard becomes a way more robust primitive from a security perspective than WBTC or CBBTC could ever be. What's been really interesting about going and pitching all of these whales, I mean, we talked to like some of the biggest Bitcoin holders, OG miners in the space. They don't trust anyone. They don't trust Coinbase. They don't trust BitGo. They don't trust your little team multisig. It's no one. They don't even trust custodians, right? Like they want the Bitcoin to be in their hands, and that's it. So like, maybe for the first time in DeFi, I mean, I'm sure it's been this way in the ETH space, but I don't think it's as front and center as it is in Bitcoin DeFi, which is, non-custodial finance has product market fit for sure. It's just a matter of us making this happen. And so I think, honestly, right now, like if you compare the security of a WBTC or a CBBTC to any of these Bitcoin LSTs, maybe besides Lombard, probably even besides Lombard right now, it's like Coinbase and BitGo backing is pretty that's pretty good economic security, all things considered. But you can get a whole hell of a lot better than that. And that's where Lombard's headed.
Yeah. Okay. Now let's kind of like shift gears. There's been, I've talked to a number of Bitcoin L2s now. How do you view Bitcoin L2s, right? Their current iterations versus what you are doing or what you are hoping to do in the future?
So Bitcoin L2s means a lot of things. I think there's kind of two categories. There's like Bitcoin sidechains, and then which is the like most of the market, all but like a couple. And then there were like people actually trying to do true Bitcoin L2s. Basically, the differentiator being, does security roll up to Bitcoin or not? The Bitcoin sidechain approach, which is like this would be like Stacks and Corn and I mean, there's like 20 others, Merlin, these kind of guys. I think these guys in general are going to have a very tough time competing with the rest of the ecosystem, because through primitives like LBTC and cross-chain Bitcoin wrappers, you can take Bitcoin to all of these different chains. So it's like Base now is claiming to be a Bitcoin L2, and Berachain is claiming to be a Bitcoin L2, and all like every existing ecosystem that can support an ERC20 can now have Bitcoin on it in the form of the wrapper. So like these guys really need to think about like what is their fundamental differentiator as both a chain and an ecosystem. And we're only working with a couple of these for that reason, because honestly, I think I don't think a lot of them will stick around long term. Like they're trying to. It's kind of like a just because I spin up a new chain and call it a Bitcoin L2 doesn't mean that anybody will actually give a shit about that. There are a couple who are doing, like, big fans of the Corn guys, obviously. I think, there's a number of others that are doing some sort of interesting stuff.
What guys?
The Corn team. This is like, this is the OG, actually the Badger DAO guys, if you remember them from DeFi.
Yeah. I remember Badger DAO,
Yeah, they're building sort of interesting. It's kind of like it's like a cross between Berachain and a Bitcoin L2. But, they're making some stuff happen. Like they are actually cultivating a community around Bitcoin that I think is kind of interesting. But maybe back to the more important point, which is the second version, which is like Bitcoin L2s actually trying to become Bitcoin L2s. So I guess the reason that the sidechains, I think are going to have a tough time competing is because they don't do anything different, right? They're just kind of like boring chains that are like slightly branded differently. In this case, like the Bitcoin L2s are actually trying to do something, which is enable a more secure version of Bitcoin. So anytime you're going to like a Bitcoin sidechain, including Lombard right now, you're trusting someone. Like there's some external security primitive on top of Bitcoin. More often than not, it's like multi-sig of some parties. Depending on how you view that, this is secure, not secure. But like for the biggest Bitcoin holders, this is not up to par. And so people are trying to create through things like BitVM, or maybe if Opcat got added back into Bitcoin Script, then people would be able to do true Bitcoin ZK rollups, and this would be like the Alpen Labs, Citria. Babylon's doing a lot of research into this. Bob team, I think, is doing some research. These guys are actually trying to do something net new, which is add a new Bitcoin native security primitive. So like when Lombard first started off too, a lot of our thesis was like, you kind of don't need Bitcoin L2s with Lombard, because Lombard enables every other ecosystem to have Bitcoin liquidity. But through a lot of our discussions with LPs, it turns out that there very much is a need for not just like there's different sectors of the Bitcoin market, right? Like Bitcoin's a $2 trillion asset. There's probably like $100 billion of demand for just a cross-chain Bitcoin L2. There's probably like, I don't know, 500 billion for like for like something in between, some sort of asset that's like really, really strong security, but not like a full Bitcoin rollup. And then there's probably like the rest of that capital probably never leaves Bitcoin main chain unless there is like a full non-custodial type of L2 built on top. And so it's like, going after slightly different markets. And I think Lombard is sort of attacking each market in one at a time.
Yeah. So how do you view like competition long run? Let's say that Opcat gets added in and there's some, like reasonable way to do ZK rollups. We'll see how practical that is, but right, they're working on it now. With BitVM 2, I've talked to the Alpin guys. Like long run, where do you see them, having an edge versus Lombard, right? Like it's a solution now. Like where you said that there's probably demand for, various trust models, but like say we get like a really like trustless, Bitcoin bridge and subsequently, the ability to do essentially the same things. Like, do you see like how do you see the market kind of fragmenting there?
I think it's pretty clear that once we establish the true non-custodial rollups through BitVM, through Opcat, through something else, then I think a lot of activity will end up converging around a couple different security models, right? But I will say, I think this is going to take quite some time, or rather, not the security models people are going to converge around. People are going to converge around certain ecosystems, But again, I mean, even if you have so Opcat and BitVM enable you to move Bitcoin from Bitcoin main chain to like some other execution environment, but it doesn't let you do a lot of other stuff. You can't take it to Solana, you can't take it to ETH, to Berachain, to all this other stuff. So I think in the short term, there is plenty of room for security innovation on creating something that like approaches the security of like a BitVM or an Opcat, but for like true cross-chain Bitcoin. So like there's sort of a couple different products here that BitVM and Opcat won't be competitive with. But I do think like, long term, it will be good to have all this activity constrained around like one or a couple different Bitcoin L2s. I think we really don't need like 15 different BitVM implementations. And I think what is going to be the big challenge here is like, I think we're at the point where the tech is basically ready for people to do BitVM, but it's going to take quite some time to get Bitcoin holders comfortable with this, right? It's not like, we have this, mechanism that is on paper, technically secure, and now like one event assumption, and now all of a sudden everybody's going to wander over to it. It's like that code is going to have to be battle tested. It's going to take a lot of user education. I mean, that in of itself, like even if these chains ship in the next like year or two, this is like a 3 to 5 year process, I think, to get people to fully understand the security mechanics. Interestingly, I saw like what was it? Matt Luongo from TBTC and one of the guys from Strata going back and forth on Twitter about like, is TBTC more robust than a BitVM that just shipped? And the answer is like, I probably lean with Matt a little bit. Like, battle tested code is more secure in a lot of people's mind, I think, than like a brand new mechanism. Like it works on paper, but we'll see. So I think it's all these things. It's like we're in the midst of an incredibly exciting time for Bitcoin DeFi because we're at the point of just battle testing mechanisms that we know are ultimately going to work. It's just going to take a little bit of time. So I mean, Lombard, I think the way we think about it is always sort of, bridging the gap, kind of taking things in stride with what the current user demand is. So I think we'll kind of lean that way, but you can bet that all of our eyes are on like BitVM, Opcat, and any sort of like true expressivity solution. Well, I actually have like one interesting little tidbit on this, which is in Bitcoin, like part of the reason I think Lombard has emerged as the leading Bitcoin LST is because, to be honest, we're like basically the only Bitcoin LST that's not like playing games. Like when Bitcoin DeFi first started, there were a couple of early market leaders who decided that like TVL games were going to be the way this was played because we don't have smart contracts where you can see all the liquidity. You just see this like little Bitcoin address. People figured out that you could do this stuff like let your investor keep it in their wallet, and you could just kind of snapshot the liquidity and pretend it's your own. And I think this is like shaken a lot of trust on the back end effectively. But what it's made us realize is like, had these people spent as much time as they did, trying to cut corners, and instead reallocated that time to thinking about like product, actually what are we building, what problems are we solving for users, they would have realized that like maybe the biggest opportunity in Bitcoin DeFi is productization of self-custody capital. If you can let a user self-custody their capital and put it to work in DeFi, you've now just unlocked like billions, if not trillions in DeFi to now go and use that. It sounds kind of funny saying that because this is what DeFi has been pitching for years and years and years and years. But I think that thesis particularly reigns true in the Bitcoin community where again, people don't want to trust anyone or anything.
My understanding of the just going back for a second, my understanding of the BitVM bridge is that it requires like a large amount of liquidity, and that you have these operators, right? And exactly. I assume that, so like Udi has made a number of points on this, and it's interesting the way he kind of describes it. I'm curious. So my assumption is that these operators are paid in some capacity, and that could be ultimately designed such that is kind of yield in a sense. What do you think about the capital efficiency of that version of yield, like a bridge operator for BitVM, BitVM2, whatever it's going to be called, versus Babylon? Like, what would be the incentive to do for whales or bridge operators to use that versus something like Babylon or even your kind of Hyperledger thing in the future? Like, where do you see that playing out?
It's a good question. My general view on capital efficiency issues within BitVM is that there's going to be so much excitement around this that these are solvable problems at the end of the day. Like, it's probably expensive to operate in the beginning, which means that BitVM teams are going to have to go out and pay market makers like a shit ton of money to park capital there or something. But again, I mean, these are solvable problems really. So I don't sort of view that as a big, it's an impediment or a challenge for sure, but not something that a good team won't figure out a mechanism to solve. So yeah, I mean, over time, I think people would figure that. And I mean, I think you, I'm not sure if this is what you're alluding to, but how great would it be if staked Bitcoin through Babylon could be reallocated to secure a BitVM bridge?
Well, that's what I was like. I thought that
would be beautiful.
Babylon is working with one of these teams currently. I think. Am I wrong?
Yeah, that's right. Yes. I'm drawing a blank on it, but they just announced this recently.
Is it Alpin or Chainway?
It's not Alpin. I don't think it's Chainway. I think it starts with an L, but we'll figure this out right after this, I'm sure.
Okay. Yeah. So does that actually work? Like, is that a real thing that you can do?
I don't think so. No, certainly not in Babylon's current design. Maybe Babylon, maybe they have something cooking on Babylon chain that will allow this. I think they're just, collaborating on BitVM research. That was the nature of the collaboration. I don't think they're actually reallocating latent Bitcoin liquidity to secure the BitVM bridge, but maybe that's what they're thinking about. It would make a ton of sense. Like, that would be a great mechanism for sure.
Yeah, but doesn't that just introduce so you have Babylon staked Bitcoin, and then you're just introducing another bridge for interblank. What reason?
Yeah, that's fair. But I think it's sort of a layer on top, I guess. Like you get the liquidity to secure the bridge. I think that would be the most important part, right? Like you would no longer have that liquidity requirement as long as you had the collateral for some amount of time. I guess you're right. Like, technically, the capital in the system is predicated on the security of Babylon as a protocol then in that case. So maybe that doesn't work quite as well as we were thinking.
Yeah, but maybe just the sourcing liquidity aspect could be the unlock there, I guess, right?
Exactly.
And if people were more willing to just I say people, I mean, I don't know, market makers or maybe just whales are more willing to just kind of natively, in quotations, but natively stake their Bitcoin and then it be allocated to that bridge to provide liquidity. But it just seems like it gets kind of complex when you're like, why are they even using the BitVM bridge there? Why don't they just run it directly off Babylon? So I guess it'll be interesting to see what comes of it.
Yeah, exactly. When you bring up a good point here. If you think of Babylon and Eigenlayer as just two of the biggest pools of capital in DeFi that they could do whatever it with.
Yeah.
I mean, they could solve all of these problems that require liquidity, instantly if they had the mechanism to do it. So yeah, I mean, it's a good point. I mean, maybe Babylon should be thinking more about these kind of use cases. And I know there's been some early ideation around this in the ETH ecosystem, but this is a good point.
Yeah. Well, I think we covered a lot. I think we got I got a good understanding. Is there anything else you wanted to add?
I don't think so, man. I think we covered a lot of it. No, just appreciate you having me on. Big fan of your work, and we'll be excited to keep jamming on the Bitcoin stuff. Appreciate you kind of like giving it the attention that it deserves, and it'll be fun to pick this conversation up in a year or 2 years, because the space is rapidly evolving. I think everybody's sort of figuring things out left and right. A lot of the I think things, Bitcoin DeFi is like relearning all of the lessons that we learned in ETH DeFi over the past 5-6 years. So big stuff is happening, driven by a lot of external catalysts, and hopefully when we're having this conversation, a couple of years from now or something like that, Bitcoin is the collateral in DeFi. There's no sort of question about this. The monetary premium is maxed out, and the ETH is money meme has fallen to the backside, but we'll see.
Awesome. Thanks so much for coming on. I appreciate it.
Awesome. Thanks a lot.